we were looking at a topic which revolved around equity settled share-based payments. And this is where we were granting options to subscribe to the company shares at a fixed price in the future. And we were granting those options to our staff, and as a result, this created an expense. We valued the option at the grant date, but because they didn't vest for 2, 3, 4, 5 years, we then had to spread that cost over the 2, 3, 4, 5 year period. Now we ran out of time. It was getting exciting, and we had dealt with share-based payments that were equity settled. But actually, there is another type of share-based payments which is cash settled, and that's where I need to pick up the story. So I'm going to do a little bit of a recap, a little bit of a comparison process between our equity settled and our cash settled. So we are back on page, well, I'm going to be looking at cash settled share-based payments, which is on page 45. So we've already talked about equity settled share-based payments, which create an expense and an equity instrument. And the accounting is based on the value at the grant date, the estimate of the numbers at the qualifying date, and spread over the qualifying period. So this is recapping from last time. Equity settled share-based payments create an expense and an equity instrument. You're granting options to directors to subscribe to the company shares at a fixed price in the future, subject to qualifying conditions. One qualifying condition is that they remain with the company as an employee, and we look to spread that cost over the qualifying period. Share-based payments are fantastic. Equity settled share-based payments are fantastic because they motivate the staff, they give us goal congruence, they're very, very effective. But there is one major drawback in that they cause dilution in your shareholdings. So there is another very, very similar type where we have here cash settled share-based payments. Now, cash settled share-based payments are sometimes known as share appreciation rights. Let's imagine you all work for the same company. And let's imagine that I am introducing and explaining to you a bonus system. Now, the bonus that you are going to get is linked to the share price. If you work harder, if we make more profit together, the share price will go up and you will share in that success. You are not going to receive an option and you are not going to receive a share. What you're going to receive is cash. You're going to receive a right to receive cash linked to the share price. So if I introduce this scheme today, and I tell you that the share price is $10 today, I could say to you, look, in 3 years' time, I will pay you $1,000 for every $1 the share has gone up. So if in 3 years' time, the share price is $13. Today it was $10. It's gone up by $3. That means you then get $3,000 in cash. No equity, no option, no lapsing, you just get the cash. Now, from my perspective, what I would then have to do is make sure that that $3,000 that I'm paying you is properly charged over the 3 years that you are working for the company. I'm not going to charge it as an expense today. I'm not going to charge it as an expense at the end. I'm going to charge it as we go along, matching concept. Because I'm going to pay you in cash, I am creating a liability. Because I'm going to pay you in cash, I'm creating a liability. So it's a cash settled share-based payment. Because the amount of cash that you get is based on the share price. So this is creating for me, this is creating in my accounts an expense, but it's creating for me a liability. If it's options, it's creating an equity instrument. Now, the accounting for a share appreciation right, we want to know the value of the share appreciation right, the value of the liability at the year end. Options, equity doesn't change, but the value of the share appreciation right, the value of the SAR, the share appreciation right at the year end is the crucial difference between the two systems. You still need the current estimate of the numbers that we expect to qualify. You still need the current estimate of the numbers we think will qualify. And we still need to spread over the qualifying period. We still need to spread over the qualifying period. What cash-settled share appreciation rights do is they create a liability, and liabilities have to keep on being remeasured. This is explained on page 45. However, rather than looking at page 45 now, what I'd like to do is to go into an example, and the example we're going to have a look at is on page 49. That example is called Windberg.